All right, today we're going to tackle one of the most popular and maybe one of the most important investment tools out there, the exchange traded fund. You've probably heard the term ETF thrown around. We're going to demystify it, what it is, how it works, and why it really could be your gateway to getting into investing. So, have you ever looked at those giant household name companies, the ones I'm talking about, and thought, man, I'd love to own a piece of that action? It's a pretty common thought, right? You see their success and you want to be a part of it. But where do you even begin? Because let's be real, going out and buying individual shares in all of those companies, that would be, well, it'd be a huge pain, not to mention incredibly expensive. You'd need a ton of cash and even more time for research. There's got to be an easier way. And, spoiler alert, there is. And that's where the ETF comes in. So for this first part, let's just get our heads around the big idea. What is this thing that's totally changed the investing landscape for millions of regular people? I absolutely love this quote because it just nails it. It's the perfect way to think about an ETF. It's like it took the best features from two different things. From an index fund, it got diversification and super low costs. And from a stock, it got that easy, flexible way of being bought and sold. It's the best of both worlds. Okay, so here's the more official definition. The key word here is basket. I want you to really picture that. Instead of going down the grocery aisle and buying every single apple, orange, and banana one by one, you just grab one single basket that's already packed with a great mix of fruit. You buy one thing, the ETF, but you get a piece of everything inside it. All right, so the whole basket idea makes sense, but how does that actually work? What's going on behind the scenes? Let's unpack this basket and see what's inside. Okay, check this out. Let's imagine a fruit ETF. Instead of trying to guess which single fruit company is going to be the big winner this year, you just buy one share of this ETF. Boom. Instantly you own a little bit of Citrus Company, a piece of Apple Farms, some Berry Co., and a bunch of others. It's diversification in a nutshell. If one of those companies has a rough year, it's okay, because the others can help balance it out. And believe me, these baskets aren't just for imaginary fruit companies. There is an ETF for pretty much anything you can think of. You can buy a basket that tracks the 500 biggest companies in the US, or a basket of bonds. You can even buy an ETF that represents actual physical gold bars sitting in a vault somewhere. You can go super broad or laser focused on one industry, like tech. The variety is just incredible. So, what's the secret sauce? How do they keep things so cheap? Well, this is it. Most ETFs are passively managed. That's a fancy way of saying there isn't some high-paid Wall Street manager actively trying to pick winning stocks. Instead, the fund is just built to automatically follow an index, like the S&P 500. It's basically on autopilot, and that automation is what makes it so incredibly efficient. Okay, so we get what they are and how they're built, but now for the big question. Why should you care? What are the real advantages for you, the investor? Let's get into why this whole basket approach is so popular. First up, and this one is huge, is instant diversification. With just one click, one single purchase, you're spreading your money out. You know that old saying, don't put all your eggs in one basket? Well, ETFs basically have that rule baked right into their DNA. It's an amazing way to manage your risk right from day one. The second massive win is the cost. Just look at that number for a second, 0.03%. That's a pretty typical fee. They call it an expense ratio for a basic ETF. It is ridiculously low. And to put that into perspective, here's what that actually means. For every $1,000 you invest, you're paying just 30 cents a year. That's it. Keeping those fees super low is so important because it means more of your money actually stays in your pocket, working for you. And when you put ETFs side by side with the more traditional mutual funds, you can really see the difference. I mean, it's pretty clear. ETFs generally win on the big stuff. Fees are way lower. You can trade them anytime the market is open, just like a stock. And, this is a big one, they tend to be more tax efficient. All of which means you get to keep more of your returns. So how do you actually make money from these things? Well, it's pretty straightforward. There are two main ways. The first is price appreciation. Simple enough, the value of the stuff in the basket goes up, so the price of your ETF share goes up. You sell it for more than you paid. The second way is through dividends. A lot of the companies in the fund make profits, and they share a piece of those profits with their shareholders, which, if you own the ETF, includes you. Okay, now we gotta be balanced here. ETFs are an amazing tool, but it's important to remember that no investment is 100% risk-free. So let's talk about a few things to keep in mind. There are really three main things to just be aware of. First is just market risk. If the entire stock market takes a nosedive, your broad market ETF is probably going down with it. That's just how it works. Second, something called tracking errors. Sometimes the price of the ETF on the market can drift just a tiny bit away from the actual value of all the assets inside it. It's usually not a big deal, but it can happen. And finally, for some of the really weird niche ETFs, there's liquidity risk, which just means not a lot of people are trading it, so it might be a little harder to sell when you want to. So after looking at the good and the things to watch out for, what's the bottom line? How should you think about ETFs in your own financial life? Here's what it all boils down to. ETFs have basically democratized investing. They've made it simple, cheap, and accessible. By rolling up low costs, simplicity, and that instant diversification all into one package, they've become an incredibly powerful tool for anyone, and I mean anyone, who wants to start building wealth for the long term. At the end of the day, that's what an ETF is. It's a tool. It's a building block for your future. And the beautiful part is that you can use these blocks to build almost anything you want. A portfolio for retirement, for a house, for whatever your goals are. So the question isn't really if you can get started anymore. It's now that you know how, what are you going to build?